In the corporate world, ownership isn't always as straightforward as it looks on paper. So today, we're going to peel back the layers on a really critical set of rules under India's Companies Act, Significant Beneficial Ownership, or SBO for short. We'll break down exactly what this means and why it's become such a vital piece of compliance for companies.
And really, this is the core question that the SBO regulations are trying to answer. It's all about looking past the names on a share certificate to figure out which individuals, which actual people, hold the real power and get the real benefit from a company's operations.
All right, so to get to the bottom of this, we're going to follow a pretty clear path. We'll kick things off with why these rules were even created. Then we'll get specific on how to define a beneficial owner. From there, we'll look at how to identify them, walk through the compliance steps, and finally, wrap up with a summary and the all-important exemptions.
Okay, first things first. It's really important to get the context here. These rules didn't just pop up in India out of thin air. They're actually part of a much bigger global push for greater transparency in the corporate world.
So where did this all start? Well, the whole concept really comes from recommendations made by the Financial Action Task Force, the FATF. In India, this officially landed in June 2018 when Section 90 of the Companies Act was amended. Detailed rules followed later that year, and this is still evolving. As recently as late 2023, these same requirements were extended to limited liability partnerships as well.
When you boil it all down, these rules have a few really key goals. They're here to stop corporate structures from being misused for things like money laundering, to fight tax evasion, and to cut off terror financing. At the end of the day, it's all about protecting the integrity of our financial system.
Okay, so to apply these rules correctly, we have to be super precise with our terms. The law makes a really critical distinction between two different types of owners, and honestly, understanding this one difference is the key to pretty much everything else we're going to talk about.
So if you look on one side, under Section 89, you've got this broad definition of a beneficial owner. This can be any person, which includes other companies. But then you look at Section 90 and it really narrows the focus. It zeroes in on the significant beneficial owner. And this person must be an individual, a real person, who has a major level of ownership or control.
So you might be asking, what exactly is that significant level? The rules set the magic number at 10%. If an individual holds at least 10% of the shares, voting rights, or the rights to distributable dividends, that's your first major clue that they could be a significant beneficial owner.
Now, this whole idea is built on a foundational concept called beneficial interest. And all that really means is the right to enjoy the perks of ownership, like being able to vote on company matters or receive dividends. It doesn't matter if you hold the shares in your own name or through some other company or trust.
So, the big question is, how do companies actually go about identifying an SBO? And let me tell you, it's not just a simple numbers game based on that 10% rule. The process involves using two different tests, one objective and one subjective, to really uncover who's pulling the strings.
First up, you have the objective test. This one is pretty straightforward. It's all about the numbers. Does an individual indirectly hold 10% or more of the shares, votes, or dividends? Simple. But then there's the subjective test, which looks way beyond percentages. This one asks if an individual has the right to exercise or is actually exercising significant influence or control, no matter what their shareholding is.
Let's dig into that term, significant influence. The law defines this as having the power to participate in major financial and operational policy decisions. And notice the wording there. It's not the power to control the decisions, but just to have a voice, to have a seat at the table. That alone can be enough to qualify someone. Now, control, that's the next level up. This means having the right to appoint most of the directors or to actually direct the management and policies of the company, whether you do it through votes, special agreements, or any other way. If someone has that kind of power, well, they're definitely considered an SBO. And this brings us to one of the most crucial principles of the SBO rules. Just holding shares directly in your own name doesn't automatically make you an SBO. See, the rules are specifically designed to uncover ownership that might be hidden behind layers of other companies or trusts. That's why having some kind of indirect holding is a mandatory condition to be identified as an SBO.
Okay, so how do you actually trace this indirect holding? The rules give us a clear roadmap. For instance, if the shareholder is a company, you have to find the individual who holds a majority stake, more than 50%, in that company. If the shareholder is a Hindu undivided family, or HUF, then the Karta is considered the SBO.
And for a partnership, it's the individual partners.
And it doesn't stop there. The rules also cover more complex structures. If a trust is the shareholder, you might need to look at the trustee, the beneficiary, or the settlor, depending on how the trust is set up. And for things like pooled investment vehicles or funds, you look to the general partner, the investment manager, or the CEO of that manager.
All right, so identifying the SBO, that's really only half the battle. The other half is all about compliance. Let's take a look at the practical reporting framework that both the individual and the company have to follow.
The whole process flows in a pretty logical sequence. First, the person who's been identified as the SBO has to declare their status to the company. They do this using Form BEN1. Next, the company takes that information and records it in a special register, Form BEN3. And finally, the company reports all of this to the Registrar of Companies using Form BEN2. But here's a key point. The responsibility isn't just on the individual. The company itself has a duty to be proactive and investigate. So, if the company thinks someone is an SBO, but they haven't made a declaration, or if a corporate shareholder crosses that 10% threshold, the company has to issue a formal notice. That's Form BN4 to get to the bottom of it. All right, let's start to wrap this up by bringing everything together, summarizing the most important principles, and taking a look at which types of entities are actually exempt from all of this. It's important to note that these rules don't apply to everyone absolutely. Holdings by government bodies, for example, are exempt. The same goes for a reporting holding company and a whole range of regulated investment vehicles like mutual funds, AIFs, and entities that are already regulated by bodies like the RBI or IRDA. So, let's just quickly recap the absolute core principles here. First, an SBO must always be an individual, a person. Second, having an indirect holding is mandatory. The main threshold to watch is 10%, but remember, the control test can apply even without hitting that number. And finally, you always have to add up both direct and indirect holdings to get the full picture. You know, a good way to think about all this is like an iceberg. The names you see on the shareholder register, that's just the tip, the part that's visible above the water. What the SBO rules do is they force companies to put on their scuba gear and dive underwater. They have to look beneath the surface to see the massive structure below, and to finally answer that one fundamental question we started with: who is really in control?